On April 7th at 5:32 p.m., Donald Trump announced a ceasefire with Iran. And from that announcement, we learned two things. First, Truth Social is apparently the single greatest invention of our generation, and definitely not a useless social media platform. And second, markets absolutely hate uncertainty, because the very next day after the announcement, the markets ripped higher. The S&P closed up 2.5%, the Nasdaq jumped almost 3%, and the Dow climbed more than 1,300 points, marking its best day in almost a year. But it didn't stop there. A few weeks later, stocks were back at record highs, even as the ceasefire was actively falling apart in real time. Traditional financial media called this a relief rally. They said the markets were celebrating peace, but the truth is, that's not what this was. This was something else entirely. And to understand what actually happened, why markets can sit at all-time highs while there's literally a war going on, you first need to understand what Wall Street looked like going into all of this, because there's a lot more to this story than just a relief rally. On February 28th, the US and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was killed. Then Iran shut down the Strait of Hormuz, and the market entered its worst 5-week losing streak in nearly 4 years. By the end of March, the S&P was down almost 9%. And while your retirement account was quietly screaming, something else was happening underneath the surface. Wall Street was beginning to panic. Hedge funds didn't just start repositioning. They were selling at the fastest pace in 13 years. And that's not a loose estimate. That's hard data, because Goldman Sachs had a front row seat to the entire show. They run what's called a prime brokerage desk, which services most of the major hedge funds on Wall Street, meaning they can see what these funds are buying, what they're selling, and just how leveraged they are. And according to Goldman's own numbers, Q1 hedge fund selling in North America was the largest since April 2020. Gross leverage was sitting above 300%, near all-time highs, and short exposure to macro ETFs like SPY and QQQ hit the highest level since the pandemic. Then, on March 19th, commodity analyst Rory Johnston said this.
Think about some kind of massive detonation in the oil market supply chain in the Middle East. And there's this shockwave that's kind of moving out. This shock is too large for the system to handle, and it will begin to creak and break the longer this goes on.
Just how many barrels per day were those disruptions, the squeeze of 2008? And how big is this in comparison?
It's bigger than anything in history. Every analyst I speak with, people again that are, I respect people that are not alarmists, people that make fun of the alarmists. They're all terrified. Let's say, the East-West pipeline is maxed. There's no issues at Yanbu. The Houthis don't get involved, et cetera, et cetera. In that scenario, with the strait remaining closed, we still need to shed 15 million barrels a day of global demand. And that just means prices, $250, $300 a barrel Brent. We will hit all-time highs in that scenario on an inflation-adjusted basis, almost guaranteed, almost by necessity. So I do think in that scenario, again, recession is too light a term. We're talking depressionary.
Fast forward 6 weeks later, and this might end up being the funniest take of the entire year. We'll come back to why in a second. But at that point, the sentiment on Wall Street was pretty clear. Everyone was bearish. Then, on the evening of April 7th, Trump announced the ceasefire. And when markets opened the next morning, it was like someone turned Jerome Powell's money printer back on. More than 400 stocks in the S&P finished green. 13 stocks hit all-time highs. Brent crude dropped around 13.5%, while WTI crude fell more than 16%, marking the biggest single-day decline since April 2020. But here's where the mainstream explanation starts to fall apart. According to maritime intelligence firm Windward, which uses AI to cross-reference GPS signals with satellite radar and imagery, only 5 outbound carriers were actually detected moving through the strait by midday. That's roughly a 96% drop in activity compared to the pre-war baseline of around 130 daily transits through the Strait of Hormuz. So, something isn't adding up. How can there be a relief rally based on world peace if there isn't actually any peace? Which raises the question, what really moved the markets? And the answer is a good old-fashioned short squeeze, and I can prove it. But for this to make sense, we first need to understand how a short squeeze actually works. When you short a stock, you borrow shares from someone and sell them. You're betting the price will drop so you can buy those shares back later at a cheaper price, return them, and pocket the difference. But if the price goes up instead, you're in trouble. Because you still have to return those borrowed shares, meaning you now have to buy them back at a higher price than you sold them for. And if the price keeps rising, your losses keep growing. At some point, your broker may send you a margin call, meaning you either deposit more money into your account or close the position immediately. And when enough people get margin calls at the same time, they all rush to buy back shares. That buying pushes prices higher, which triggers more margin calls, which triggers more buying. and that's a short squeeze. And on April 8th, with macro short exposure at the highest level since 2020, the squeeze began. But the squeeze was only the first domino to fall. Because once stocks started ripping higher, the algorithms kicked in. And this is where CTAs, commodity trading advisors, enter the story.
Oh no!
Oh no!
Oh no!
Oh no!
Oh no!
Oh yeah!
These are systematic trading firms that run on rules-based models. They don't care about news. They don't care about geopolitics. They simply follow trends. When the trend is down, their algorithms go short. When the trend is up, their algorithms go long. It's completely mechanical trading. Goldman reported that CTAs were sitting on roughly a $30 billion net short position going into the ceasefire. But the second the S&P crossed certain trigger levels, those models flipped. And they didn't just flip to neutral. They flipped aggressively long. Goldman originally estimated these CTAs would need to buy around $40 billion worth of equities to exit their short positions. But the actual number ended up being $86 billion across just 5 trading sessions. According to Goldman's records, that was one of the 5 fastest buying sprees of all time. And then came the third domino, the options market. Dealers on the other side of options trades have to remain delta neutral, meaning when customers pile into call options, dealers hedge that exposure by buying the underlying stock. And Spot Gamma, a leading financial data platform, had already flagged a negative gamma regime heading into the ceasefire. That's the type of environment where dealer hedging stops stabilizing markets and starts amplifying moves instead. Prices go up, dealers buy more. Prices go up more, dealers buy even more. 3 dominoes falling one after another. That's the rally. That's what we actually saw. And here's the funny part. This isn't even the first time we've seen this happen. A very similar pattern has repeated itself over and over throughout the last decade. Go back to December 2018. Stocks had been crashing for months because investors feared more rate hikes. Then Jerome Powell stepped on stage and said one word: patient. And the Dow exploded higher. It was the first time in history the Dow gained more than 1,000 points in a single trading session. Or look at August 2024, when the Bank of Japan raised interest rates for the first time in 17 years. The yen carry trade started unwinding. The Nikkei dropped 12% in one day, then bounced 10% the very next day. Different catalysts. Same mechanics. And the reason this keeps happening is because the structure of the stock market itself has fundamentally changed. 20 years ago, markets were dominated by humans, portfolio managers reading earnings reports, analysts modeling cash flow, people making discretionary decisions about what companies were actually worth. But today, that market is basically gone. Now, 63% of all US stock funds are held by passive indexers. Trillion of blind money that doesn't read earnings reports or care whether Apple had a good quarter. It simply follows the index on autopilot. And because most passive funds are market cap weighted, the bigger a company becomes, the more of it these funds automatically buy. Which is exactly how the Magnificent Seven now make up over 33% of the S&P 500. So a massive portion of the market isn't really being priced anymore. It's just receiving automatic allocation, and what's left of active investing has changed too. The hedge fund industry has consolidated into a handful of giant multi-strategy firms. The Millenniums, the Citadels, the 0.72s of the world, and their assets under management have exploded over the last decade. These firms typically operate with 4 to 8 times leverage and strict drawdown rules. Meaning when they hit certain loss limits, they don't sit in a conference room debating whether the Fed will cut rates or whether the war is truly over. They just sell, immediately. And underneath all of this sits the options market, because same-day expiration options now make up around 63% of all S&P options trading. On peak days, more than $2 trillion of notional value changes hands in a single session. And every single one of those trades forces a dealer on the other side to hedge in real time, which means buying or selling the underlying stock to keep their books balanced. So the dominant players in today's market aren't analyzing valuations or fundamentals anymore. They're reacting. And when prices move, their reactions stack on top of one another. That's what happened on April 8th. And once you understand these mechanics, once you understand why markets behave irrationally, everything starts making a little more sense. So if you're tired of traditional financial media giving you the dumbed-down version of what's happening in markets, hit subscribe, because this is the stuff they conveniently forget to talk about. Because the stock market, we all used to know, the one built around finding undervalued companies and investing in them for the long term, that market is gone. What's left is a giant feedback loop of algorithms, passive funds, and options dealers, all reacting to each other in real time. And the headlines? Well, They're mostly just narratives people use to rationalize what already happened.